Uh, Morning, everyone. So we are now looking at Fin 4801. And for Fin 4801, you see that there is 17 study units that they examine on. And previously it was 16 study units, but the 17th one is on mergers and acquisitions. And for the chapter which looks at mergers and acquisitions, in the previous sitting, they didn't really examine on that particular chapter. So we'll see exactly how it goes, but we checked if they adjusted anything, but we are planning on our schedule. We're planning to do the chapter on mergers and acquisitions. So we just check to see how, if there's made any adjustments to the curriculum for this year. So when it comes to the study units that you're going to be covering, they basically go hand in hand with the chapters that are in the textbook as well. So for the chapters that are in the textbook, you will see that the first 8 chapters of the textbook, it's mostly a revision of the concepts that you are expected to have done when you're doing your undergrad. So the first 8 chapters, which is the first 8 all right, please make sure that you where you are seated, you have a good reception. Because if you have a bad reception, you see that the you will struggle to have a good visual, and you also struggle to hear me clearly as well. So please make sure that you have a good reception where you're seated, because on my side, I always check to see if everything is going well using a second device that I also have as well. So please make sure that where you are seated when you're having the class, there is a good reception where you're seated as well. Otherwise, you will struggle to hear me when I'm conducting the class. So please ensure that you have a good reception where you're seated. So as I was saying, the first 8 chapters of your curriculum, it's mostly concepts that you have seen when you're doing your undergrad. But from chapter 9 onwards, you will see that you are now going to look at the concepts in what? At a higher level as well. And you are expected to actually be able to look at them, because chapter 8, 9, and 10, they're basically very much linked with each other as well, because they look at capital budgeting. So you see that from chapter 9 onwards, you are now looking at the material at a higher level. But the first 8 chapters, it's assumed to be material or a revision of the material that you've done when you're doing your undergrad. So don't be puzzled when you see that the concepts that you're doing now from the first 8 chapters is going to be things that you would have seen at undergrad level. But from chapter 9 onwards, that's when you see that you're now doing things at a higher level, because some of the concepts, they come back again, but at a higher level that you've done, that you would have done in the first 8 chapters as well. Also, our schedule is that between now until the end of October, that's when we should have completed going through the different study units for the curriculum. So our timetable that we have made available, if you don't have access to the timetable, please let us know so that we give you access to the timetables. But I'll just send through the link of the timetables on the different groups as well, so that you're able to have the timetable on your side as well. So please make sure that you take note that from now between until end of October, we are saying that this is the time that we are going to be, no matter what happens, by end of October, we should be done going through the curriculum, so that November, December, January, and February, that's when we're going to be going through a revision. So we need to make sure that we leave as much time as possible to do revision as well. And our expectation is that unless anything else changes, you guys should be writing your exams end of January or sometime in February there. If there's any changes, we are also in a position to also change our timetable as well, but we'll see exactly what the lecturers say regarding any changes to the timetable. But I'm not expecting the changes to the timetable to be significant, like what they did with the undergrads as well. Also, you see that for Fin4801, I think you should be expecting about 4 or 5 assignments that you're going to be going through. Some of the assignments are going to be short questions. Some of them are a bit more comprehensive as well. So what we will do is that the short questions type of assignments, we'll be assessing and judging to see exactly if there's a need for us to do those assignments in class or assist you with those assignments separately as well. So we'll see exactly how we are going to be going through the assignments. But those assignments which are a bit more comprehensive and more structured are the ones that are going to be setting aside time during the class period to actually go through those questions as well. So we'll communicate with you accordingly, depending on exactly how much material needs to be covered in the assignments and how comprehensive the questions are going to be as well. Is there any questions before we go on? And also, before I forget, make sure that I'm going to send through a link on the different groups for you guys to create a user account. Because once you create on the user account that you guys are going to be creating, this is where you're going to be able to get the different material, like for example, the electronic version of the textbook, the videos of the, because all our sessions are recorded. So which means that this is where you're going to be able to access the videos of the sessions that would have gone through, so that in case you missed the session, or in case there's something that you didn't understand during the session as well, you'll be able to go back to it and also go through the video of the session that would have had as well. So make sure we are going to make sure that you, during the course of the week, you are able to access those who have indeed created the user accounts. Make sure that you create the user account so that you're able to access the videos of the sessions that are going to be having as well. And what we also do is that at least whenever we finish a particular chapter, what we will do is that we'll make the video available of the next chapter that are going to be covering, or the next class that are going to be covering, so that you already have that video in advance, so that if you want to go through that chapter alone on your own in advance, you can use that video of the class that we would have done in the previous year to guide you through those chapters, so that now, when you come to the actual class of the next session that are going to be having there, you would have gone through the material in advance for yourself, so that if you do that, you will find that you not struggle so much when it comes to understanding the different concepts, because you would have gone through the material. If there's anything you don't understand, you would have actually given yourself enough time to actually ask questions in the classes as well. So we always encourage you to go through the videos, because we find them very, very useful. Even in the previous students as well, they found the videos very, very useful when they are looking at preparation of the exams as well. Because what we also do is that once you are able to have the access to the video as well, even if in November or December or whenever, before you write your exam, if you want to go back to the video of maybe there's a chapter that is still giving you problems, you can still go back to the video of the chapter that is still giving you problems and attend the class on that particular video on your own time as well. So please try as much as possible to utilize the videos that we make available to you, because they are quite useful when it comes to reviewing the concepts that you're still struggling with as well. So are there any questions before we go on to the first study unit? Are there any questions? All right, so going on to the first study unit, the first study unit is going to be based on chapter 1. So the first study unit looks at chapter 1, and chapter 1 looks at the overview of the financial management. So chapter 1 looks at overview of financial management, and under introduction, it says this text is essentially about financial management of business enterprises. So companies face two major financial management decisions. Which assets should the company invest in, and how should the company finance these investments as well? So which means when it comes to financial management, it always goes back to the concept of the accounting equation, where with the accounting equation, you say your assets is equal to equity plus liabilities. So the accounting equation, it says your assets is equal to equity plus liabilities. So which means in this case, when it comes to the accounting equation, your choice of exactly which assets you're going to be investing in, for example, when you look at capital budgeting, this is where you are going to be making investment decisions. So this is the side of the accounting equation where you're going to be making investment decisions. Then your choice of exactly how you are going to be financing the different assets is where you are going to be making the financing. So this on the right hand side of the accounting equation, this is where you are going to be making the financing decisions as well. So when you look at the financing decisions, this is where you're not going to be saying what are the different sources of financing that you're going to be looking at or utilizing as well, where the different sources of financing you're going to either consider to utilize your ordinary share capital, or you're going to consider to utilize your retained earnings, which is basically your retained profits from the previous over the previous years. And this is where you can also consider utilizing the preference share capital as well, if the company is able to access the preference share capital, which is basically more like a hybrid between equity and liability, because it basically carries characteristics of equity and also carries characteristics of liabilities as well. Then there is also your choice of liabilities, where you're now going to be saying, how are we going to be financing using the liabilities? Are we going to be financing using the loans, or are we going to be financing using bonds? So these are the basic form of liability that you're going to be looking at. Although we know that with liabilities, we can also classify them as short-term or long-term liabilities as well. So the main source of financing that we're going to be looking at when it comes to liabilities there is mainly the loans and the bonds, where you're not going to be saying, are we going to be getting a loan from the financial institution to finance this investment in assets, or are we going to be getting issuing bonds if the company is able to issue the bonds as well. So this is where they're basically saying that when you're looking at your financial management, you're basically looking at making investment decisions and financing or financial decisions, financing decisions as well. Are there any questions before on the accounting equation before we go on? So going back to the textbook. So going back to the textbook, we on section 1, we look at the context of financial management, and they go back to the history of the development of financial management. We're not really going to worry much about them because I don't expect anything to be asked or examinable there. But I just want to briefly show the links with economics and how it links with accounting as well, right? So you see that how financial management links with economics is that basically the economists are the ones who are going to be are the ones who prepare the models that we basically use when it comes to financial management. Like, for example, the different models, like for example, the dividend discount model or free cash flow valuation models. In most cases, the economists are the ones who are going to be who are basically more responsible, or are going to be ones who are going to be more responsible towards preparation of those particular models that you are basically going to that the financial manager is going to be using. Then there's also a link with with accounting, where the financial manager is also going to be having links with how it links with accounting is that the financial manager needs to know exactly how the financial statements are prepared using the different accounting standards. But then at the end of the day, the financial manager's responsibility is not necessarily just to look at the preparation of the financial statements. It's more on the side of using the financial statements now to be able to make investment and financing decisions. So this is where you are going to be looking at the where financial management basically comes in. It's mostly linked with accounting, where you're using the financial statements available to make investment and financing decisions as well. So on page 3, they basically look at the different links where they say with economics, how do individuals, organizations, countries make the best use of the scarce resources? Then the financial with financial management, How does the financial manager use best practice to add value to the capital received in the form of debt and equity and thereby create wealth? And the financial manager is the one who's part of the financial management system, is the one who's now going to measure, but is going to be measured by the value created by finding projects with returns that are greater than the firm's what cost of capital. Because remember, it also goes back to the economic principle where we say the economic principle is that for every economic decision that you make, you must ensure that your benefits are more than what your costs. Which means that if your benefits are more than the costs, it basically means that you are going to, this is where the financial management decisions making is going to be coming in, where you're saying that your returns, which is your benefits, must be more than your cost, which is in this case is the what cost of capital. That's why you see that when you look at the different capital budgeting models that we're going to be looking at, like for example, the net present value method, the internal rate of return method, they are basically based on the economic principle of whatever decision you make, you must ensure that your benefits are more than what your costs. Then if the benefits are more than your costs, then it's considered to be what a good economic decision as well. On section 2, we look at the environment of financial management. So we look to see exactly how the environment of financial management is evolved from a South African perspective as well. And when you look at the environment of financial management, how it has evolved from a South African perspective, I don't expect this to be something that would be highly examinable in the exam, but it's something that you just need to know from a practical point of view as well. So I'm just going to quickly brush through the developments, but I don't expect it to be something that I would say spend a lot of your time practicing, mainly because it's not something that I would say is highly examinable. I've never seen the lecturer ask new questions based on something like that. If ever it comes, maybe it can come in assignments, but not necessarily from an examination perspective as well. So when it comes to the environment of the financial management, they talk about regulation and deregulation, and they're basically saying that governments are increasingly removing regulations that restrict economic activities. So there's a movement more towards what removements of regulations that are basically restricting economic activities. That's why you see that as we are becoming more of a global economy, global community as well, you see that many economies are basically opening up their markets as well to other people, and they're also expecting the same to be happening with other economies as well. So that's because of this, how they open up the economies is through the movement removal of many regulations that were there in the previous years, in the previous eras, like for example 20 years ago, 30 years ago as well. So there's more movement towards deregulation basically. Then on page 4, they also look at issues of taxes, and they're basically saying that when it comes to the issues of taxes, there is the taxes to attract investment. Many governments have decided to actually lower their taxes. So it's a one way of actually attracting investments. That's why you see that from an American perspective, when Donald Trump took over, one of the first things that he did was to lower the corporate taxes as well, as a way of trying to incentivize the American companies to come back to America and were basing their operations in America, who had moved away to other countries, like for example, who had moved to China as well. So to try to incentivize companies to actually invest in countries, in their countries as well, governments have actually tried as much as possible to lower their taxation, so that, because they know that if they lower the taxation there, the companies are also going to be able to actually increase their profitability. And remember, the profitability is a short-term goal, but the long-term goal of the firm, which is the ultimate goal of the firm, is to maximize shareholders' wealth. And how do they do that? Is that if they're able to maximize profits in the short run, in the long run, they're going to be able to actually maximize the shareholders' wealth as well. Next is the issue of interest rates. And if you check there, they say interest rates have fallen significantly over the last 2 decades. And you see that one of the reasons why the interest rates have gone down is mainly because of many economies were trying as much as possible to actually recover from the 2008 economic recession and the other recessions that also happened before that. And you also see that even from the current economic environment that we're in because of the pandemic as well, you see that many governments have also lowered their interest rates. Even if you look at the Reserve Bank, the Reserve Bank, they've also lowered the interest rates. Now that's why you see that the interest environment that we are currently in is lower, mainly because they are trying as much as possible to try to revive the economic activity so that the people are able to access more financing for their different projects as well at a cheaper cost. Then when it comes to inflation, they say inflation has fallen significantly and companies are currently operating in low inflation environment. So that's why you see that one of the mandates of the Reserve Bank is basically inflation targeting, where they want to keep the inflation between 3 to 6% or within that particular range as well. So which means that they are trying to ensure that the businesses are operating in a low inflation environment so that there's no huge fluctuations when it comes to the pricing of the goods and services as well. Then there's also privatization and nationalization. And they say the privatization of firms such as telecom means that the government has followed a policy of transferring business to the private sector. So which means they are doing this mainly because they want to ensure that the companies are able to utilize the resources more efficiently and also to be more competitive as well. That's why you see that, for example, when it comes to telecom, because they saw that we were moving away towards more towards the mobile ways of communicating as well. You see that telecom, if it had stayed with the old system where they were using landlines there, it would have actually struggled to actually to remain competitive. Hence, you are seeing that they moved more towards the mobile industry as well, and it's part of the moves that they've done when they were looking at privatization, and mainly because governments that's one of the things that they were trying to do, to open up the economy as well. Then we look at commercialization and high input costs, and they say this, the South African government is committed to process of commercialization, commercializing certain business entities such as Transnet and Eskom. So the focus is on making the public sector more efficient. However, higher electricity tariffs are increasing the cost of doing business in South Africa. And it's not only the issue of high electricity tariffs as well. You will see that there's also an issue of load shedding that is also coming in as a cost to many other enterprises as well. So they also have to make sure that they try as much as possible to improve when it comes to commercialization and lowering the input costs as well. Because if there's the big organizations are going to be facing an environment where there's higher cost of electricity, which is one of the huge expense that many businesses face, and also load shedding, which means that even the electricity will be high. Sometimes they're not able to operate efficiently because of load shedding as well. It basically means that it's an issue that the government would have to make sure that they also address as well. Then there's also broad-based BEE, where they say the implementation of the broad-based Black economic empowerment is leading to changes in corporate ownership structures, management profiles, employment, procurement policies, and financing structures. So the effect of BEE is generally seen as positive for South African economy, mainly because they want to make sure that more people have access to the economic activities as well. Although it has its own flaws, but the main idea is to ensure that more people have access to the South African economy as well. Then next, we look at globalization and internationalization. And here they say globalization has forced South African companies to be internationally competitive, and South African companies have expanded into foreign markets and have obtained listings in London and New York as well. So this is where they're basically saying that because of globalization, So to keep up with the competitive, because of the economies are becoming are being opened up as well. So to take advantage of the opening up of the different economies as well, it basically means that the South African companies also need to make sure that they are also able to open up operations in different countries as well and take advantage of that. Because if the moment the more they're able to do that, the more they're able to maximize the value of the entity as well. So you see that mostly when you look at the issue of Steinhoff, where they were having operations not only in South Africa but across the world. And you also look at companies like MTN and all these other different companies, South African companies as well. Then we also look at mergers and acquisitions, and here they say increasingly we are seeing firms merging, and there is increasing consolidation of many sectors. For example, the acquisition of SubMiller by AB InBev resulted in the world's biggest brewer. So this is where the acquisition of SubMiller, remember by that German company, it basically ended up creating a big company, which is basically one of the which is the world's largest brewer as well. So this is how companies can also be able to actually grow and be able to increase their market share through mergers and acquisitions as well. Then another issue that has to be borne in mind when it comes to financial management is currency exchange rates, mainly because currency exchange rates have an effect on the value of the enterprises, especially when you look at the multinational companies as well. So here they say foreign exchange rates are highly volatile, and companies are required to factor in future exchange rate movements in their investment and financing decisions, mainly because the movements in exchange rates can end up affecting the acceptability or rejection of a particular project as well. And one of the main key factors that also affects the valuation of the different investments is going to be the movement in exchange rates. And because of the high volatility nature of these exchange rates as well, it basically means that there is any huge variation between the actual exchange rate and the estimated exchange rate there will end up highly affecting the decision that the company would have made as well, to say the acceptability or rejection of a particular investment. Then on page 5, they also look at growth in the use of financial derivatives. So which means that the use of financial derivatives there has also resulted in financial management becoming more and more complex through the use of derivatives, like for example forward contracts, futures contracts, options, and swaps as well. So it has resulted in financial management becoming more and more complex as well, which means that usually derivatives are used to hedge, but if you're now going to end up, if the company ends up using the derivatives for speculation purposes there, this is where it can also result in huge losses for the enterprise as well. Then there's also developments in China, the US, and in Europe, especially when you look at the developments when it comes to the whole pandemic as well, and also what happened in the previous over the past 10 years, where we had a recession in 2008 as well. You will see that the Chinese economy has now grown aggressively over this period to even be competing with a country like the US as well. And you also see how the US and China also having those trade frictions, because they are because of their fight to be dominating economies as well. And you also look at the issue of Europe and how it comes in, and how the different economies in Europe have been affected by the pandemic, and how the different countries in Europe also have been affected by the recession that we have seen in 2008 as well. And it will be very interesting to see exactly how these countries as well are basically going to be emerging from the pandemic, because remember, it's still ongoing. That's why you see that many countries are trying as much as possible to make sure that they vaccinate their people as quickly as possible, because they know that the moment they have to enforce a lockdown, it results in a lot of huge losses when it comes to economic activities and the growth of the economy as well. That's why you see that the main factor that resulted in the negative GDP when it comes to 2020 was mostly because of because of the pandemic and the lockdowns that resulted from the pandemic as well. Although the economy was also struggling, but one of the main driving factors why the South Africa suffered as well was mainly because of the issue of the pandemic. So it's some of the things that you have to look at, or developments that you have to look at when you look at what as a financial manager, to see exactly how you to position your organization as well. Then the next issue is sovereign ratings, where they say S&P downgraded South Africa to below investment grade in 2017. Well, Moody's and South reviewed for a downgrade as well, and you see this rating as well, which means that it becomes very, very important when you look at the sovereign credit ratings, mainly because the lower your credit rating, the higher. Remember, we say when you look at your the cost of borrowing, the interest rate, your nominal rate of interest, your nominal rate of interest is given as your real rate of interest plus inflation premium plus risk premium. So your real rate of interest, your nominal rate of interest is given as your real rate of interest plus inflation premium plus risk premium as well, right? So which means because of this, we also know that this makes up your risk-free rate of interest. So which means that even the same principle also works with what? With sovereign rating as well, because if risk goes up, it means that the cost of borrowing is going to go up. And which means that if the risk goes up because your credit rating has gone down, it means that your cost of borrowing as a country is expected what? To go up, which means that in future, if the country is going to be borrowing money, it's now going to be borrowing at what? At a higher interest rate, which is going to be what? End up being too costly for the economy as well. So that's why you see that the government is always going to be very much interested in what's happening to what? With the credit rating as well, because the credit rating ends up affecting what? The cost of borrowing, because of the issue of the risk premium. Next, we look at economic developments in Africa. So we also look at to see exactly how the different economies are developing in Africa, and you see that this is where you have to look at they say the vast economic potential of Africa and improving macroeconomic outlook, structural changes and reforms, and real economic growth will provide opportunity for South African firms as well. So which means that the vast opening up and the growth of the different economies in South Africa, in Africa, also opens up opportunities for what? For South African companies. Like that's why you see that it would be very interesting to see exactly how the South African companies are also taking advantage of the opening up of economies, like for example, growing economies, like for example, Rwanda as well, where there are more opportunities that the South African companies can also exploit when it comes to these as well. And you also hear of the free trade area that the governments are proposing to implement when it comes to the SADC region as well. So those are some of the things that are those are some of the economic developments that are also going to be affecting the different companies across Africa as well. Then there is also issue of business disruption, where they say companies are increasingly subject to disruption, and business models may quickly come under pressure or even become obsolete as well. So which means we can see what Amazon is doing to retailers, how Airbnb is impacting what? The hotel sector, and how Uber is affecting what? Taxi operators, and what Netflix is done to videos and demand for DSTV as well. This is very much self-explanatory to see exactly how the business disruption is going to be. That's why you see that every business has to always continue to spend a lot more money on innovation, because if they don't spend money on innovation, they're going to be left down. They're going to be left out when there's going to be what? Those business disruptions that comes in when the new idea comes in, which basically wipes out the current model as well. Then there is also the issue of demographics, where they say the aging of the population in Europe, parts of Asia, and the US and Australia is causing shifts in demand patterns for products, and there's implications for public spending as well. Mainly because if typical example is where you look at a country like Japan, where they are now having a situation where the birth rates are very low, and at the same time the aging population is also increasing as well. So it will be very interesting to see exactly how such governments are going to be able to actually mitigate such measures. And when you look at the mitigation measures that the governments are going to be put in place to ensure that the economic activity still continues, this would be very interesting to see exactly how businesses now would be able to actually exploit such demographic changes over time as well. Then the last issue that they discuss here is climate change, where they say the effects of climate change are becoming increasingly relevant and will impact on financial decisions, operating costs, and demand for firms' products. So where a firm locates effectively will be affected by access to resources such as water. That's why you see that there was quite a lot of friction during the Trump era, where the corporates were acknowledging that we have experienced climate change. We need to make sure that we mitigate the effects of climate change, because they know that it's going to end up affecting how they also do business as well. That's why you see that the government, the Trump government, was always in constant friction when it comes to the climate issue with the corporates and even with other countries as well. So are there any questions regarding these developments before we look at the forms of business organizations? Any questions? All right. If there are no questions, we go on to the forms of business organizations. So this section, I really don't think that the lecturer is going to be asking questions. You just need to know that there are different forms of business organizations, so that whenever they are going to be asking you questions at the back of your mind, you always have to make that, you bear that in mind in answering the different, if there's going to be a case or whatever information that they give you as well, to see exactly how the different business organizations are basically structured and also run as well. But remember, for Fin4801, because the lecturer is expecting to ask you questions at a higher level, I wouldn't expect the lecturer to be asking you such questions where to say, what are the different business forms of business organizations? What are the advantages and disadvantages? If these questions come, typically they would come as an assignment question, but not necessarily as an exam type of questions. I wouldn't expect you to be asked as an exam type of question as well. So when it comes to the forms of business organizations, there are different forms of business organizations, which where the main broad category would be a sole proprietorship, a partnership, a company, and a CC. Then there are also different categories that also fall in between there, but those are the main categories there. Then when it comes to sole proprietorship, this is where they say this is the most common form of business organization, where where there is no separation between the owner of the business and the business itself. Hence, they say with the sole proprietorship, there is unlimited liability, which means that if the business is owing money and there's no money to be recovered by the creditors, they can still go on and attach whatever the owner of the business owns, which is separate from the organization as well. So a typical example or a typical way of understanding how a sole proprietorship is structured is how you I'd like to go back to the example of the ladies selling magazines. They do everything. They are the supply. They are basically they are the ones who are responsible for the production. They are the ones responsible for the financing. They are the ones responsible for the marketing. They are the ones responsible for acquisition of the material as well. So which basically means that that's why they say that there's no separation between the business and the owner of the business, mainly because the owner of the business is basically doing everything there as well. And this also comes with its own advantages and disadvantages as well. So please make sure that you take note of them, although it's not something that I would say would be highly examinable. Then the other form of business organization is a partnership, where they say a partnership may be formed when two or more persons come together to start a business. So from an individual partner's viewpoint, it is identical to every respect what a sole proprietorship, except that the profits and losses are divided in agreed proportions. So which means that with the partnership, this is where two or more individuals come together to start a business, right? So now when they come together to start a business, it basically means that they are going to be, they are going to be having their own, they are going to be having responsibility that they are going to be allocating to each other in running the business. But at the end of the day, just like a sole proprietorship, there's no separation between the business and the owners of the business as well, which means that there is what? Unlimited liability. So this also comes with its own what? Advantages and disadvantages, mainly because the advantages is that they're able to bring in more resources, they're able to share the skills, they're able to actually what? Contribute towards the management of the business as well, which means that they're able to what? To be a bit more efficient than what? Than a sole proprietorship. But it also comes with its own what? Disadvantages as well, where that at the end of the day, there's no separation between the business and the owner of the business, which basically means that if a partner makes one of the partners makes a wrong decision, it's still going to come back and what? And affect all the other partners as well. Then there's going to be a close corporation, which is a CC, although I wouldn't expect anything to be coming from there, mainly because there's no longer a registration of what? Of new CCs. Only the existing CCs that are able to continue running. So here they say a close corporation may be formed between 1 and 10 persons who are referred to as members. So members each have proportional interest in the business. So unlike a partnership, the interest of a member may be sold without terminating the existence of the business. Because with the partnership, if one partner wants to walk away, it basically means that the whole the business has to be terminated there as well. So don't just know, but I don't expect anything to be coming out of as questions to say, to be asking questions to see exactly how a system will be structured and the advantages and disadvantages there. The next section looks at the company, where they say the company is a separate legal entity from the owners and is governed by the Companies Act. So this means that company is legally, the company is legally like any other person and can buy, sell, and transact in its own name. So it can enter into contracts and raise finance, is required to pay tax, and has the same rights and responsibilities as a natural person, which means that it can what? It can sue or be sued. So here they say the owners of the company are called shareholders, as ownership is represented by shares of a company. So if a company is a separate legal entity apart from the shareholders, it means that the shareholders have limited liability. So this means that shareholders are only at risk up to what they've invested in the company. So if the company fails, then the creditors cannot look to the personal assets of the shareholders. So this will encourage investment and enable companies to raise large amounts of capital and enable shareholders to effectively diversify their investments. So this is the typical characteristics of exactly how the company would be structured as well. And the main characteristics which separate a company from the other forms of business organizations that we've looked at there is mainly because there is going to be limited liability. So there is limited liability when it comes to a company as well. So the summary of the structure of the different entities there is given on table 1.1. Is there any question regarding the forms of business organization before we move on? The next issue is the issue of taxation. So the next issue is the issue of taxation. And when it comes to the issue of taxation, they say taxation is a significant cost to business. So tax laws are complex and constitute a separate and specialized field of study. However, it is important to understand certain basic tax principles that affect the daily decision made in a business enterprise. So they are considered briefly below: taxation of company profits. And generally, the tax rate that is going to be affecting the company profits is 28%. But if they bring in a question in the exam, they will tell you exactly what the tax rate is. So when it comes to the taxation of company profits, I'm just going to quickly as well, towards the end of this section, I'm going to quickly go through the different structures of the statement of comprehensive income that you need to make sure that you always know at the back of your head or by heart, mainly because you see exactly how to prepare the statement of comprehensive income and where the taxation issue comes in when it comes to the profits as well. Then there is also another issue of assessed tax losses. And here they say a company is permitted, subject to certain conditions, to carry forward to future years any losses incurred in the normal course of business in prior years. So this is of value, as this will result in future tax saving if the company returns what? To profitability. So if a company has any tax losses over the years, they can still be able to claim against those tax losses when they now start what? Making being profitable as well. Then another issue is capital gains tax, where they say individuals and companies are subject to capital gains tax, which represents a tax on gains made on long-term assets. So the capital gains tax is basically that tax that is going to be charged whenever the assets are disposed of at a value which is more than the cost of the asset. So if the assets are sold at a value which is more than the cost of the asset, the difference between the cost of the asset and the price at which the assets are going to be sold, or the process from which the asset is going to be sold, that becomes your capital gains, and it's going to be taxed accordingly as well. So which means that you always have to make sure that the issue of capital gains taxation is also going to be coming in as relevant. Then after this, they also talk about individual taxation. I'm not really going to worry much about individual taxation, because remember, from Fin4801's perspective, we're going to be more concerned with what? From a company's perspective. And from a company's perspective, we know that the taxation issue is going to be based on what? Capital gains and profit tax on what? On profits as well. Then there's also dividends withholding tax, and this is more on the shareholders' perspective, where to see exactly how much they are going to end up getting whenever they are going to be paid what? Dividends by the company as well. But remember, when you look at Fin4801's perspective, when you're looking at analysis of the financial statements, we're going to be more on the side of the company itself, not necessarily from what? Shareholders' perspective as well. The analysis is going to be more on the company's perspective. So when it comes to individual taxation and dividend withholding tax, just know them, but I don't think it's something that you need to worry much about when it comes to preparation of the exam. So now, when it comes to the concept of taxes on profits, so when it comes to the concept of taxes on profits, please always make sure that you know this template of the statement of comprehensive income. So please know this template of the statement of comprehensive income, because whenever we're going to be looking at analysis of ratios or any other concepts, we are always going to be looking at what, even when you look at capital budgeting, where you are looking at calculations of the operating cash flows there, you are always going to be going back to the statement of comprehensive income as well. So you see that with the statement of comprehensive income, your aim is to see exactly how much profit the enterprise is going to be making, and to see how much profit the enterprise is going to be making, you are going to say your sales, which is your revenue, minus your cost of sales, and this will give us the gross profit. So your sales minus cost of sales gives you the gross profit minus operating expenses, and this will give us the earnings before interest and tax. So your sales minus cost of sales gives you the gross profit, minus operating expenses gives you the earnings before interest and tax. Sometimes, instead of giving you information to get the earnings before interest and tax like this, you will see that they can also give, instead of giving you to say, these are the cost of sales, these are the operating expenses, they can now split them to say, these are the fixed costs and these are the variable costs as well. So which basically means that you can also say your sales minus your variable costs minus your fixed costs, and this will give you the earnings before interest and tax. Usually, when it comes to this, we can say here, including depreciation. So that here we're going to say minus depreciation. If this mention depreciation separately, it basically means that you're going to say your variable cost minus fixed cost minus depreciation gives you your earnings before interest and tax. If they give you this, it means that sometimes they'll give you the figure of depreciation, and then you'll see exactly how much your operating expense, but they will tell you whether the depreciation is being stated separately or included in the operating expenses there as well. So this is how you're able to get the earnings before interest and tax. So just make sure that you take note to see exactly whether they give you this information or they give you this information. Either way, it will take you to the what? Earnings before interest and tax. So this will be the same. Then from here, I'm going to say minus interest expense, and this will give us the earnings before tax minus taxes. And in most cases, they give you the tax rate at 28%, but take note, every question that they're going to be giving you, if you need to be able to calculate the taxes there, they will tell you exactly what the tax rate is going to be. Whether they give you 28% or they give you 30% sometimes, just make sure that you take note to see exactly what the tax rate is, but it's always going to be given to you if it's relevant for the particular question as well. So if you say minus taxes, this will give you the profit after taxes. So this will give you the profit after tax. So if they say the profit after tax or the operating profit, it's basically one and the same thing. Then sometimes you might also be expected to find out exactly how much the profit available to ordinary shareholders is going to be, which means that if you say minus preference share dividends, so minus the preference share dividends there, so this will give you the profit or earnings available to ordinary shareholders. So this will give you the profit available to ordinary shareholders as well. And remember, this profit available to ordinary shareholders is the one that you're now going to be transferring to get your retained earnings in the balance sheet as well. So please make sure that you take note of this template for the statement of comprehensive income. So which means, remember, we're talking about the tax on profits. So the tax on profits that they're talking about there is basically this tax on the earnings before tax. So please make sure that you take note of this template. Any questions? Are there any questions? All right, let's move on. On page 10, on page 10 of the textbook, which is section 3, we look at what is the fundamental objective of financial management. So what is the financial objective of the financial management? And here they say the objective of financial management is to maximize the value of the firm. So the goal of the firm is to maximize shareholders' wealth, and you are able to maximize the shareholders' wealth through maximizing what? The value of the firm. And remember, how do you do that? It also translates to maximization of what? Price of the share as well. So if you check on that section on the last paragraph, they say companies may focus on corporate profitability or growth in sales, and although these may be aligned with shareholder value, these measures are at best incomplete and may lead to poor decision making. For example, a focus on growth could lead to company to destroy value. So we will come back to this issue later in the book. For now, we will analyze the limitations of the objective of profit maximization. And here they say, why profit Why is profit maximization not the right objective for corporate finance? And here they're saying the reason why profit maximization is not the right objective is mainly because profits can be subject to accounting manipulation of what? Accounting profits. So they can be the profits of the business can be manipulated. That's why you see that there's always an issue when it comes to the presentation of the financial statements. That's why they say ideally when it comes to a company, when you're analyzing a company, you would prefer to look at or to utilize audited financial statements because what they have been reviewed by a qualified auditor as well. Mainly because sometimes they can be management can actually manipulate the presentation of these financial statements to make the company look as if it's highly profitable, when in actual fact there are other issues that are also driving the profitability, which are not sustainable in the long run as well. Then there is also issue of timing, where they say profit maximization does not directly factor in the time value of money. So it does not take into account the time value of money, mainly because a project that results in a total profit of 20 million per year for 5 years would be preferred to a project that generates 10 million per year for 10 years. So reason being is mainly because back to the issues of time value of money. So which means that's why you see that they always have to look back and see exactly what is the effect of time value of money when it comes to assessment of the project as well. Ideally by discounting the future cash flows back to present value. Then there's also another issue of cash flows where they say accounting profits do not always reflect cash flows. So profits are determined by the company's accounting policies, while its corporate finance is focused on on cash flows. So which means here, what they're basically trying to say is that when you look at the accounting profits, one of the factors that drives profits for the enterprise is the issue of your sales. Some of your sales are on cash, and some of your sales are on credit. So which means a company might appear as if it's highly profitable when they're doing a lot of their sales, when they're selling a lot of their goods on credit, where they're saying, for example, to customers, pay us after 6 months or after 1 year or after whatever period of time. So because of this, what do we see? A company would be highly profitable, but at the same time, the company will be struggling because they don't have cash, which is the lifeblood of every business. So because of this, the company will be looking as if it's profitable, but if you invest in this company, then you later on realize that the company ends up struggling as well. Why? Because they are not taking into account to see exactly how much cash flow is actually within this particular business for the company to be able to actually continue running as well. So the effect of cash flows is going to be very important. So which means that the company, if they are selling a lot of their goods on credit there, the company will be highly profitable, but without actual cash within the enterprise as well, which will result in a situation where the enterprise would be struggling to continue operating. So here they say accounting profits and the cost of capital, where they say accounting profits do not include an adjustment for the cost of equity financing. So in practice, accounting profits are often reported in terms of the company's earnings per share. So this is determined by dividing the company's net profit by the number of shares issued by the company, right? So they say, for example, we may discuss accounting profits of 100 million in the number of shares of 40 million, and the earnings per share would be $2.50 per share. So management may be focused on growth in earnings per share, but this may be wrong objectively as shown with Enron, but more about that later. So the important issue is that accounting profits only reflect the actual costs and not the opportunity costs. So an important opportunity cost is the cost of shareholders' funds or the cost of equity, which is not taken into account in determining the accounting profits. So which means that when you look at the accounting profits there, they're not now telling you exactly how much profits, how much are you foregoing when you're seeking, when you're pursuing these profits as well. And these profits, how is this profitability compared to the cost of pursuing these profits? Because remember, at the end of the day, you have to make sure that you always compare your costs against your benefits as well. Hence, they say the accounting profits are not going to be a reliable assessment to see exactly how the company is doing as well. Then there's also another issue of risk where they say profit maximization ignores the impact of risk on value. So shareholders will prefer less risk and will value a company not only in terms of the future cash flows, but also in terms of the risk of these cash flows as well. That's why you see that the risk of those cash flows is going to end up affecting the discount rate. So if the risk of the cash flow is going to end up affecting the discount rate there, you need to ensure that you're able to filter in the risk, which will end up affecting the discount rate, which also end up affecting what? The valuation of the company as well. Because if you're assessing the value of the company, you have to remember we say the value of a company today is the present value of expected future cash flows. So when you're discounting these future cash flows back to present value, you're going to be discounting them at a discount rate. And we know that the discount rate is going to be made up of your real rate of interest, inflation premium, and risk premium as well. So which means that in doing that, it basically means that but if you're so which means that the cash flows that you're going to be discounting there are not necessarily are going to be you're going to be discounting the cash flows, not the profits of the enterprise, mainly because, so which means that when you're going to be pursuing profits as the goal of the firm, it basically means that you are ignoring the effect of what? Of risk in assessing what? The different projects that you're going to be looking to pursue as well. Next, we look at shareholder want management to maximize value. So what is appropriate objective for management to follow? So it should be able to encompass all that has been mentioned before. So shareholders want management to maximize the value of the firm, which really means that in the long term, management should maximize the value of the shareholders' interest in the company. So in most cases, this is measured by maximizing the value of the what? Of the share price. So which means in the short run, yes, the management can pursue high profitability, but in the long run, management needs to be able to pursue what? Maximizing what? The value of the company. And how do you maximize the value of the company? By what? By making sure that you're able to maximize what? The share price of the entity as well. So this is how you're able to be, so this is how you're measured to see exactly if you're able to maximize what? The value of the company by looking at the maximization of the what? Of the share price as well. So when it comes to focusing of financial management in decision making, so when it comes to focus on financial management decision making, they basically look at this where they say, when it comes to remember the goal is to maximize the value, and in maximizing the value of the company, you want to ensure that the return of the investment is more than the cost of capital. So which means that to be able to maximize the value of the company there, you want to minimize the cost of capital and maximize what? The return. So which means, if you still remember from undergrad, there is this graph that you used to have, or that was in the textbook that you used when you were in your undergrad, which was something like this, which showed it showed the firm value, and it also showed the cost of capital, and it also showed the level of debt as well, right? Where we said when it comes to the cost of capital, we know that there is we have the cost of debt, and then we have the cost, sorry, we have the cost of equity, and we also have the cost of debt, where we said we also have the costs, the weighted average cost of capital. And this is where we found the weighted average cost of capital. So this is the, for example, this is the point where we're saying that this is the point where the weighted average cost of capital was at its lowest. So this is the point where the graph was saying the weighted average cost of capital was at its lowest. And remember, we also saw this graph, which also showed us the firm value as well. My graph is not that exact, but it should be somewhere here. So this shows that they share the same x-axis there, right? And remember, we say to maximize, the goal of the firm is to maximize the firm value, And for you to be able to maximize the firm value, you must make sure that your cost of capital is at its what? Is at its lowest there, right? And for your cost of capital to be at its lowest there, it basically means that you are going to be financing with what? Remember we said your accounting equation says your assets is equal to equity plus liabilities, which means that if you are going to be financing your capital of the business, you're going to be financing with equity and debt, which is liabilities there, right? So which means that to maximize the value of the firm, you must make sure that your cost of capital is what? Lowest. Remember, weighted average cost of capital is the combination of financing with equity and liabilities. So this is where you find the weighted average cost of capital. So which means that to make sure that you maximize the value of the firm there, you must make sure that for you to maximize the value of the firm, you must what? Minimize the cost of capital. So this is what they're trying to explain on that section, where they're basically saying that the goal of the firm is to maximize the value of the firm. And how do you maximize that? By making sure that your returns are more than your cost of capital. And this is where you want to make sure that you maximize, you minimize the cost of capital and maximize what? The investment return. Because if you're able to maximize the investment return there, you're able to maximize the value of the firm as well. Is there any question regarding this graph before we go back to the textbook? Is there any question regarding this graph before we go back to the textbook? All right. So going back to the textbook, so this is where they're saying that for us to be able to achieve this, we must make sure that when it comes to our investments decision, we must be able to maximize the return that we're getting from our investment decisions. And when it comes to our financing decisions there, we must make sure that we minimize the cost of capital when it comes to our financing decisions. So this is basically what the graph is trying to explain on this particular section. Any question regarding this figure 1.3? Another concept which links to the goal of the firm, which is to maximize the shareholders' wealth, is the one that looks at the economic value added. And please take note, I'm sure when you're doing your undergrad, you saw this concept of economic value added when you were looking at investment management at third level as well. And the economic value added is also referred to as your residual income. So I'm sure when you're doing your undergrad, you saw the concept of residual income. So just take note that whenever they refer to the economic value added, it's basically the same concept as as your residual income. Where we say your economic value added, remember we said that we know that the goal of the firm is to maximize shareholders' wealth, but we know that we cannot be pursuing profitability as the goal of the firm. So we need to pursue maximization of shareholders' wealth. So how do you judge or calculate this maximization of this shareholders' wealth? One method that is used to find the value added on your projects so that you're able to maximize shareholders' wealth goes back to the economic value added model as well. So if the economic value added model, you're now going to be saying your economic value added is given as your operating profit after tax minus your cost of financing. So your your operating profit after tax minus your cost of financing gives you the economic value added for a particular period. So that's how you're able to get the economic value added there. How this links with the goal of the firm being to maximize shareholders' wealth is that you're going to be calculating the economic value added for each period. Then when you discount this economic value added over the life of the project, you're now going to be able to find the value of the firm. So which means, for example, if the project is going to be running for a period of 3 years, it means when you're using the economic value added principle to find the value of the firm, you're going to find out exactly what is the economic value added in year 1, what is the economic value added in year 2, and what is the economic value added in year 3, and what is the current book value of the entity in year 0. So this is the principle that you follow when you're looking at the economic value added. And remember, you're looking for the economic value added because you're trying to find out exactly how much is the value, how much value added, how much is the value add that is going to be achieved from what pursuing these other projects that we're going to be pursuing over the life of the project, isn't it, right? So which means in this case, when you discount these economic value added now back to present value, and then add them to the book value of the enterprise. And this is where you are now going to be able to determine what the firm value is. And remember, the firm value is basically going to be the value of your assets. So for you to be able to find the value of the firm, when you look at the economic value added principle, we are going to be saying the value of the firm is given as the present value of the economic value added plus the book value of the enterprise. And remember, the goal of the firm is to maximize these shareholders' wealth by maximizing what? So if you're able to maximize the economic value added, you're able to maximize what? The firm value at the end of the day. Any question? The next concept we are going to be looking at is where they discuss the issue of what about the ethics of maximizing value. And here they say, this is a difficult question, and what we need to separate the honest and hardworking managers from the rogues. So there is nothing wrong in the objective of maximizing value. What may be wrong is how this is achieved. So for example, to reduce cost, a company may make use of child labor to manufacture goods in the developing country. So increasingly, companies face reputational risk from following such practices, and this may reduce the value of the company's brand. So unfortunately, the corporate landscape is littered with unethical practices by a number of companies. We believe that ethical standards are fundamental in corporate finance and make sense in the longer term. So companies that follow blatantly unethical practices will not survive. So how is it possible to transact in business without trust? So financial managers should focus on the interests of the shareholders, but should act in a responsible way. So here, when it comes to the issue of ethics and maximizing value, they are basically saying that there is a link between a company acting ethically and the goal of the firm as well. Remember, we said the pursuit of profitability is a short-term goal, but the long-term goal is to maximize shareholders' wealth, which means when a company is acting ethically over the long run, they are going to be able to continue, they are going to be able to survive, and more people are going to want to do business with that company because they have a good reputation. So because of this, it basically means that there is a link between the company acting ethically and the value of the company, mainly because of the link where if a company is acting ethically, over time, people want to do business with that company and the company is able to survive. Mainly because if the company is acting unethically, in the short run, they might be able to maximize profits, but they're not going to be able to survive in the long run for them to be able to actually achieve that goal in the long run as well. So because of this is basically what they're saying, that is the link between a company acting ethically and the long-term goal of the firm, which is basically to maximize shareholders' wealth as well sustainably. Are there any questions before we go on to section 4? Any questions? So we are now looking at section 4, and section 4 looks at the role of the financial manager. So when you look at the role of the financial manager, you see that the financial manager is going to be making investment decisions and also making financing decisions as well. So when it comes to investment decisions, this is where they explores investment opportunities and makes investment decisions as well, right? And on the other side, they explores financing opportunities and makes financing decisions. So when they're making investment decisions, this is where they're going to be deciding on whether to invest in how much is going to be invested in operating assets, non-current assets, and current assets there as well. So which means these would be the operating assets of the enterprise there, right? Then there's also going to be an decision on exactly how much is going to be invested in what financial assets of the business. And the financial, so which means that the financial assets of the business would probably, for example, if they decide to buy shares of another company or whatever they decide to invest in as well. So these would be the financial assets of the business. So which means that when they're making investment decisions, it's either they're going to be choosing to say, how much are we going to invest in operating assets or financial assets? And if operating assets, how do we structure the non-current assets and the current assets as well? Then when they make financing decisions there, this is where they are looking to see exactly how are we going to be financing the assets that we want to invest in. Are we going to be financing the assets by getting the money from the capital markets, or are we going to be getting the money from the what? Money markets. And if it's coming from the capital market, this is where they're going to be saying how much is coming from equity and how much is coming from what? Sources of debt as well. So this is basically what the financial manager, this is basically the activities of what the financial manager is going to be pursuing as well, right? So which means that at the end of the day, this is how they're going to be looking at opportunities for them to be able to create the wealth, which is basically through able to achieve the goal of the firm, which is what? Maximizing shareholders' wealth as well. So when they are looking at investing in operating, so they can consider investing in operating assets, like what you said, like what I was explaining, they can consider investing in operating assets, or which is basically your non-current assets or your working capital. And then they can also look at investing in what? In financial assets there. And here they say, what are financial assets? These investments in equity shares, preference shares, or bonds, as well as other financial instruments such as derivatives, money market investments, are classified as what? Financial assets. So which means that these are the investing activities of the entity which are not to do with the core operations of what? Of the enterprise as well. Then they also look at financing decisions. And when they look at financing decision, this is where they look at the selecting the optimal financing mix. And remember, this is where I was saying that they can either consider to find out exactly how much are we going to be financing is going to be coming from the capital markets. And remember, the capital markets, this is where they're going to be saying how much are we going to be getting from what? Issue of shares, and how much are we going to be getting from what? Issue of debt as well. Then they also consider to find out exactly how are we going to be financing from what? Money markets, and where this way they're saying that the money market play an essential role in satisfying short-term financing needs. So this need arises most frequently in what as a result of of the cyclical or seasonal nature of the business. So it would be an unnecessary waste of resources to borrow funds for a long term and then keep them idle for a large part of each year. So remember the main difference, like what we did when you're doing your undergrad Fin4801 or your financial management in second year, you will see that this is where you are looking to see exactly what are the sources of financing for the enterprise. They can be from capital markets, or they can be from money market sources there, right? And remember, the main difference between the capital market and the money market sources is that the capital markets are long-term in nature and the money markets are short-term in nature as well. Then, apart from these as well, there are other sources of financing that the enterprise can also utilize, like, for example, financing from what? Creditors. Because the mere fact that the supplier is giving you goods on credit, in a way, the supplier is financing you, because they're saying, here's a good that we're going to give you to make money for yourself, and then you can pay us that money what? Later on as well. So which means that it's, in a way, it's a financing that you're also going to be getting from what? From the creditor. And another way is financing from what? Retained earnings. So this is basically where the company can utilize the retained earnings as a way of financing what? Their projects. So when they're utilizing the retained earnings, this is where they're going to be saying, where if we're going to be, for example, in most cases, you find the issue of retained earnings when the company is making decision to say, we want to maintain our financing mix. For example, we want to have 60% equity and 40% debt, right? So which means that to maintain that financing, financing structure, how are we going to be financing when we're going to be pursuing new projects? And you will see that, we'll see that later on as well, where one decision that they can make is to say, For the equity part, we can utilize retained earnings. Then if we have exhausted retained earnings, that's when we're going to be looking at what? At issue of ordinary shares as well. So this is another financing source that we can also utilize to finance what? Projects, or which is basically investment decisions or the investments of the enterprise as well. So is there any question when it comes to the investment and financing decisions and the structure of how it is in the balance sheet as well? Any questions? Next, Section 5 looks at the fundamental concepts of corporate finance. And the concepts that we're going to be looking at here is the concept where the first concept that you need to make sure that you bear in mind is the present value, where they say the value of an investment today is the present value of expected future cash flow. So whenever you're trying to value an investment today, you're going to be saying that the value of the investment today is the present value of expected future cash flows. So because of this, it basically means that you also always, when you're making assessing the cash flows as well, or when you're making investment decisions or capital budgeting decisions, you also take into account what? The time value of what? Of money. So which means that you need to now be able to see exactly how are you going to be assessing or discounting these future cash flows there back to present value by taking into account what? The time value of money as well. Then another issue that you also have to take into account is the risk and return relationship. And remember, when it comes to investments, we know the higher the risk, the higher the what? The expected return. So generally, the higher the risk, the higher the expected return. And how do you determine this expected return? One way that you can determine this expected return is through the use of the what? Capital asset pricing model, which we'll look at later on as well. And also, even the capital asset pricing model, it's based on the principle where we say the required return is given as the risk rate of return plus the risk premium. But we'll explain exactly where this comes in when it comes to the risk rate of return plus what is the risk premium. Because remember, the risk premium in this case is the equity risk premium, where the equity risk premium is made up of your market return minus risk rate of return. Then the net difference between the two is going to be multiplied by the what? By the beta, but we'll look at it in detail later on when we look at the capital asset pricing model in detail as well, when we look at the chapter on risk and return. Then next, we look at the no arbitrage principle, where they say, what is arbitrage? Arbitrage occurs when we buy and sell the same good in different markets to take advantage of any difference, any price differences. So if gold is trading in London for a higher price than in Joburg, then we can buy the gold in Joburg and sell the same amount of gold in what? In London as well. So this represents an arbitrage opportunity. A more inclusive definition states that the arbitrage occurs when one is when we are able to make risk-free gains, and when we're able to make gains with no investment. So of course, an average gain is possible if traders make mistakes in setting prices, but we do not expect that such price difference would persist for a long time. So in corporate finance, no arbitrage principle is important for determining prices for commodities, bonds, and what? Derivatives and equities as well. So we assume a no arbitrage principle, where we're saying that the price of securities there does not have any arbitrage opportunities there. Then we also look at the efficient markets, and here they say the efficient market hypothesis postulates that securities market reacts immediately with and without bias to any new information. So the efficient market hypothesis assumes that prices fully reflect all available information. So if the efficient market hypothesis actually applies in practice, it is possible for any investor to earn a consistent return in excess of the return warranted by the risk class of the investment as well. So which means that when it comes to the efficient market hypothesis, we're basically saying that information is fully reflected in the pricing of the security. So which means that we're not going to be looking at the questions that are going to be looking at in the questions that are going to be looking at in practice. The assumption is that we are going to be assuming that the market is efficient. Next, we look at the portfolio theory. And here they say the portfolio theory intuitively, so almost intuitively, we all know that the dictum is that that we should never place all our eggs in one basket. So this is another way of saying that if we are able to behave in a rational manner, we should diversify all our investments so as to reduce what? Our risk as well. So the portfolio theory basically says that whenever you are looking at assessing a particular investor's portfolio as well, we are going to assume that this investor is a rational investor with the goal being to what? Overall reduce what? Their diversifiable risk, so that the only risk that they're going to be able to be left with there is the non-diversifiable risk, or what we call the systematic risk as well. Then this portfolio theory is the one that is also comes in hand with the capital asset pricing model, where they say the price of an asset is usually stated in terms of the required return on the asset. So such a return will clearly reflect the estimated risk of the asset. So the capital asset pricing theory attempts to measure the risk of the financial asset and express the price in terms of what? The required return. So we'll look at it later on in the chapters where we look at risk and return to see exactly how is the capital asset pricing model linked to what? The assessment of the different investments there, where we say that with the capital asset pricing model, we are saying that the required return is given as your risk rate of return plus the beta in brackets, market return minus the risk rate of return. I'm assuming that you've seen this model so many times before when you're doing your undergrad in different modules as well. Then we also look at financial analysis, and here they say corporate finance requires an understanding of financial statements. So remember what I said, as a financial manager, yes, you are going to be looking to see exactly, you need to know exactly how the financial statements are prepared, but your main aim is to be able to what? To analyze the financial statements so that you're able to make what? Investment and financing decisions there. So that's basically where the financial analysis part comes in when it comes to corporate finance as well. Are there any questions before we move on to section 6? All right, so looking at section 6, they say this looks at do managers act in the interest of shareholders? So here they say the separation of management and ownership means that the managers of many large listed companies own a very small portion of the shares of the company. So this means that shareholders and management have an agency relationship. So which means now when it comes to the question on whether managers act in the interest of the shareholders, this is where there's an agency problem which arises, where the agency problems arises when the interest of the manager does not go in line with the interest of what? Of the shareholders. So the agency problem arises when the manager is pursuing their own remuneration at the expense of the goal of the firm, which is what? To maximize shareholders' wealth. So whenever the interest of the manager does not go in hand with the goal of the firm, this is basically where the agency problem basically arises as well. So that's basically what they're trying to demonstrate on this section. So just go through it, but there isn't much that I would say would be highly examinable in detail when it comes to the issue of the agency problem there as well. So usually how they deal with the agency problem is that one way that they can deal with agency problem there is basically where you look at compensation plans, where they can say they can try to have compensation plans which tries to incentivize the managers to ensure that when the managers pursue and make decisions which are also going to benefit them, at the same time these decisions are also going to end up what? Being able to maximize shareholders' wealth as well, like for example, through bonuses or any other incentive plans that they also are put in place as well. Then there also another issue, or another way that they can also make sure that the agency problem between the managers and the shareholders is the agency problem is mitigated is through the threat of what? Of takeovers, because they know that the managers know that if the company is taken over by new owners of the business, what is going to happen? In most cases, there is going to be an issue where when the new owners comes in, they usually brings in their own what? Management team as well. And then the current managers are going to end up what? Being out of the company or being demoted as well. So to avoid to ensure that their interests there's no agency problem there, the threat of takeover also comes in, mainly because if there's a threat of takeover from another company, the managers are always going to ensure that they maximize, they are going to make sure that they protect the interest by what? Maximizing the value of the firm, and at the same time by doing so they're going to be what? Acting in the best interest of of the shareholders as well. So some of the management incentives that they talk about, they also offer management incentives, share options. They also offer management incentive and share options as well, which are used to actually ensure that the interests of the shareholders of the management are also in line with the interests of of the shareholders as well. And one of the issues that also came about is basically where there was when you look at the financial crisis as well, but I don't think it's something that I'll say would be highly examinable because they are referring to the King 4, and I don't think that they will never ask you questions regarding the King 4 code of conduct as well. I don't think they would ask you such questions. So don't stress much about that as well. Another issue or another agency problem that also arises is the agency problem that arises between the shareholders and the bondholders. So here they say when banks lend funds to a company and when investors purchase a company's bonds, they do so in the basis of the risk of existing assets, future assets, the level of borrowing as a percentage of the total assets and the riskiness of future cash flows. So yet management may undertake the following actions to transfer the wealth from the debt holders or bondholders to the shareholders in the short term. So they can issue more debt as this will reduce the value of the existing debt. They can increase dividends, which means that the debt holders will have less security. They can increase the risk of the assets as the full benefits will flow to the shareholders, while the losses will partly be borne by the debt holders. So yeah, this is basically where they're saying that because the shareholders have the voting rights and they're able to influence the direction in which the company is going to go, typically through the annual general meetings. It would also mean that when they make those decisions which are going to be in their interest, they might pursue pursue decisions which are in their interest, which will benefit them if they pay off, but at the same time would increase the risk of the debt holders. And remember, the debt holders, if they already agreed that they're going to be charging 10% interest, no matter how much risk the company ends up taking there, they will still get the same 10% interest as well. And when the profits go up, they still get the same amount. So there's no incentive for the debt holders for them to be able to for the company to take on more risk there as well. So this is basically where the agency problem comes in between the shareholders and the bondholders. So is there any question from section 6 before we go on to section 7? Section 7, don't worry about section 7 because section 7 looks at corporate governance and the King 4 as well. I've never seen the lecturer asking questions from section 7. So when it comes to section 7 there, I would say just leave it out completely. And even section 8 as well, I would say leave it out completely as well. So section 7 and section 8, which looks at the King 4 code of conduct there, don't worry about them. Don't spend your time going through those sections. Don't worry about them. In practice, yes, you need to know them, but for the preparation of the exam, I would say don't spend your time going through those sections because I've never seen questions being asked there from those sections there. Are there any questions before we go on to section 9? So section 9 looks at corporate strategy. And here they say corporate strategy is about direction and action. So it is important that a company sets out its mission and objectives and understand the business environment that it's operating in. So financial management decisions should be aligned with the company's corporate strategy. So a key question relates to how a company should create a sustainable competitive advantage in each sector it operates in. So should the firm focus on low cost or differentiation strategies? Often a company needs to decide what businesses the company should be in and then focus on making decisions that increase the value of the firm. So this also means that sometimes a firm should divest if poor performing divisions as well. So which means, so in that pursuit of maximizing the value of the firm, there are different strategies that the company can also follow. And the first strategy that they discussed there is Porter's 5 forces model. And with the Porter's 5 forces model, this is where you look at the say Michael Porter of Harvard, based on extensive research and company interviews, set out 5 forces that impact the corporate and in industry profitability. So the first one being the level of rivalry among existing companies in the sector. So which means that if the level of rivalry is high, it means that the profitability of the company is expected to be what? To be low. But if the level of rivalry is low, the company is also expected what? To have what? Higher profitability, because they can now be able to have control over the what? Pricing of the goods and services as well. So you must make sure that you are able to explain that in case they bring it, although I've never seen this question being asked in the exam itself. Then the second one is existence and threat of substitute products. So if there is existence or threat of substitute products, if there's going to be a substitute product that the company can be that can be utilized there, it basically means that the company will have very control over the pricing of the goods and services as well. Because if there's no existing or substitute product, it basically means that the company can now be able to actually have more control over the pricing of the goods and services. But if there's an existing substitute product, or there can be a substitute product that other people can also utilize, or the customers can also utilize there, it means that the company will have less control over the pricing of the goods and services. Then the third one is the threat of new entrants and existence of barriers to entry. So which means that if there is barriers to entry, it means that the company has more control than what the customers, which basically means that if there's a barrier to entry there, it means that there's lesser competition, which means that the company would have what? More control over the pricing of the goods and services. But if it's easy for new entrants to enter into the industry there, it means that the company has less control over this demand of the goods and services. And because of that, it means that they also have less control over the pricing of the goods and services as well. Then when it comes to the bargaining power of customers, if there are few customers in the industry, it means that, and more suppliers in the industry, it basically means that the customers are the ones who are having the more bargaining power. And in that case, it means that the customers are the ones who are able to actually control the pricing of the goods and services. But if there are more customers in the industry and less suppliers there, it means that the suppliers are the ones who are going to be having more control over the goods and services. Hence, the bargaining power of customers and the bargaining power of suppliers there, it's all to do with the number of customers or the number of suppliers within that particular industry. If there are few suppliers, it means that the suppliers have more control over the pricing of the goods and services. And if there are few customers than suppliers, it basically means that the customers are the ones who are going to be having more control over this pricing of the goods and services as well. So are there any questions when it comes to the Porter's 5 forces model? I've never seen this being examined in the being something that they examine that the lecturers have examined in the textbook, mainly because yes, from last year and this year they have brought in a bit of theory questions, but most of the questions that the lecturer prefers to ask is case-based type of questions as well. And with the case-based type of questions, they give you a case and they expect you to answer questions based on that particular case as well. So there's been very little when it comes to the asking of questions when it comes to theory questions. So I've never really seen this being a concept that would be highly examinable. But please just take note of it so that in case they change the structure, we would be prepared to answer the questions as well. Any questions when it comes to the Porter's 5 forces before we go to another corporate strategy, which is the SWOT and the PESTEL analysis as well? So when it comes to the SWOT analysis, this is where they say a company will often face internal and external forces which impact positively or negatively on the company's performance. So SWOT analysis is employed to set out a company's internal strengths and weaknesses and a company's external opportunities and threats. So a company should focus on strategies and decisions that will make the most of its strength and avoid decisions that will bring to the fore its weaknesses. For example, a major strength for a company, for a pharmaceutical company, may relate to its strong portfolio of drugs under patent. So a further strength may relate to the wide distribution network and sales marketing teams. So a major weakness may relate to the fact that the company has few new drugs under development, particularly in the biotech sector. So to address this weakness, a pharmaceutical company may adopt a strategy of increasing its research and development capabilities, and may also decide to purchase or enter into a joint venture with a smaller biotech company, which is a number of new drugs in the pipeline, but has weak distribution and marketing capabilities. Then, when it comes to opportunities and threats, they say opportunities and threats relate to external factors. So a threat may relate to the entrance of a new competitor. For example, the entrance of Walmart into South Africa. South African market may pose a threat to a company such as Pick and Pay. A stronger rand exchange rate would be expected to increase the margins of a company such as Mr. Price that imports most of its clothing products from Asia. So a weak rand may be threat to a company such as Mr. Price, so which sets out, so which means that in this case, table 1.4 is the one that basically sets out, which means that if a company is now going to be analyzing itself, they are going to be looking at the strength and the weaknesses, which are basically internal factors that the company is going to be assessing. Then they're also going to be looking at what opportunities and threats, which are basically the external factors that the company is going to be assessing. So just go through these through the SWOT analysis, although I've never seen these questions being asked previously in the previous in the previous exams. But if they do come, please make sure that you're just able to understand and know exactly how to identify the strengths and weaknesses, the opportunities and threats for any given company that they may bring as a case study as well. Although I've never seen the question being asked in such a way over the previous years. The last one is the PESTEL analysis, where they say the PESTEL analysis refers to the framework for considering the political, economic, social, technological, environmental, and legal factors that will have a material impact on the company's operations and level of profitability. So what do these factors include? So which means that when you look at political factors, this where the company is going to be looking at the taxation, the tariffs, labor legislation, environmental regulation, trade barriers, impact of government policies such as income grants, provision of housing, healthcare regulations, education, and infrastructure as well. So companies may win or lose if there is a change in the in these factors as well. So they have to actually assess these factors to see exactly how the factors are going to end up affecting the operations of the company going into the future. Then they also look at economic factors, which are interest rates, economic growth rate, inflation rate, exchange rates as well. So lower interest rates may lead to a greater level of disposable income and greater spending by consumers, thereby increasing the demand of the company's products as well. So that's how you would actually analyze it when you look at the economic factors. Then there's also social factors, which looks at the population growth rates, changing demographics and the age distribution, focus on safety, rising black middle class, changing values such as credit, focus on food quality and health, increasing demand for travel. So a growth population and a growing black middle class have increased the demand for the products of many South African companies as well. Like, for example, look at where they say such companies as Truworth, they benefited greatly by a rising black middle class with access to credit as well. Then we also look at the technological factors, which are advances in software and IT capabilities, research and development, automation, robots, rate of change in processes. So the improvements in IT has enabled companies to monitor sales very carefully so that invest in inventory management and orders reflect product sales, particularly for companies such as Edcon, Truworth, and ShopRite. So when it comes to the technological factors as well, this is where you would now see that when it comes to use of, for example, Zoom by companies, where instead of people now, because of the lockdown, being stuck at home, not being able to go to work, with the advancements in technology, companies are still going to be able to continue running, where people are going to be having meetings via Zoom or Microsoft Teams as well. So this is where it would come in. Then the next one is environment, where they say climate change and the impact of the South African mining legacy will impact on the agricultural sector and other sectors that make material use of what? Water resources as well. And lastly, you look at the legal issues, which is basically the legal factors such as increasingly legal risk relating to competition law, environmental law, consumer protection laws, access to credit laws, employment and labor laws, health and safety regulations are all having material impact on the what? Corporate strategies as well. That's why you see that in most cases, these laws are protecting what? The consumers more as well. And as they're protecting the consumers more, it basically means that the company now has to assess their strategy so that they're in line with what? Legal requirements as well. So on section 10 and 11, you can go through them, but I don't see anything that I would say is highly examinable there. So from section 10 and 11, you can go through them, but I don't see anything that is highly examinable. And when it comes to the structure of the text as well, please bear in mind that, like what I told you, the first 8 chapters of the textbook, you are going to be seeing a lot of things that you're familiar with. So you're going to be seeing a lot of material that you're familiar with. So it's going to be more or less like revision of what you've done at undergrad. So if you know that you are well up to date with what you've done at undergrad, it's going to be easier for you to go through these chapters. But if you are not, if you know that you've forgotten, like many students, things that you'd have done at 3rd year level or 2nd year level, I would advise you to try go through them in advance so that when you go through them again in class together with me, you will be able to actually you won't get lost in after that, you won't need to go back through that material ever again. But when it comes to, this material now prepares you for the concepts that you're going to be finding in chapters 9 all the way to 17 as well. And remember, in chapters 9 all the way to 17, you're now going to be asked going through the material at higher level, at honors level as well. So this is where you're going to be expecting a bit more new concepts, which are also more demanding concepts as well. So this is where we're going to be going. This is where we're going to be ending today. And please take note that when it comes to the next class, I'll make sure that the video for chapters 2, I'll make available the video for chapter 2, so that once you create a user account there, you'll be able to access the video for chapter 2 as well. Are there any questions? Are there any questions?